asking Congress for a federal gas tax holiday or loosening regulations to get more ethanol content gasoline on the market.
Yeah, and speaking of affordability, Tyler, thank you so much. Tyler Kendall, our Bloomberg Washington correspondent. Speaking of affordability, U.S. mortgage rates rising for a fifth week, sending the 30-year fixed-rate mortgage to 6.46%. So let's talk a little bit about how markets and investors are processing all these developments. We're joined now by Carol Schleif. She is Chief Market Strategist at BMO Wealth Management. Carol, I'm sure you heard the president's speech last night. Did you learn anything new from it? How does it inform your thinking of how you advise your investors, your clients?
Well, first off, thanks for having me. And not sure we heard anything that clearly was just to markets first thing this morning, because we're hoping to go into that longer weekend with a few more nuggets. And it's really important to remember when it comes down to the stock market in particular, stock market's looking for quick, easy to understand bottom line hits. If they were reading a book, they prefer the spot run version as opposed to War and Peace. So trying to figure out the nuance of what's said, what's been done. There's no question that militarily they've achieved a lot of objectives over there. But what the markets are really keying in on is that Strait of Hormuz, and can we get it open? Can we get some energy going through? It is very true that we are substantially less dependent, if you will, on Middle East oil than we have been in prior shocks. But the price of oil is a very globally integrated price, and so increases that impact mostly Southeast Asian and European sources, if you will bleed over into what goes on in the rest. So for investors, we've been cautioning through all of this, just sit tight. We entered into this period, if you will, with the U.S. economy and global economies in much more solid shape than in prior shocks, and so there's a strong foundation and footing to be able to assess what goes on. And if we've learned anything in the last year and a half, it's really that you have to be cautious about wanting to knee-jerk respond to the latest social media headline or headlines.
Of course, the last time that we saw oil prices at these kinds of levels, it was back in 2022 when Russia invaded Ukraine. How are you thinking about the trajectory of oil prices and how long they stay up there, and whether 2022 serves as a good point of comparison with it?
It's tough to use that as the point of comparison because there's a lot that happened. There was a lot going on with the dollar. There was a lot going on with inflation. There was a lot coming out of the pandemic in a very labor market. And the other factor is we also have a very strong technological innovative cycle that's well unleashed, if you will, now, not just AI, but lots of other things going on that are actually having a deflationary impact potential on prices, not the least of which is the hiring in the labor market and the fact that we've got a smaller pool but a lot smaller demand. So you've got a lot of factors that are different this time around, even though we're always told you never supposed to say it's different. It's always a different factor to it.
Right. Very well said. So having said all that, and you're making the point that the U.S. is more insulated than the rest of the world, much of which is importing oil. We're in a good position, relatively speaking. So where do you want to be in terms of exposure to different sectors? Do you want to be in energy, or has the easy money been made there?
I think a lot of the easy money has been made there, and it's really important to remember that looking at the aggregate markets is pretty deceptive because they're really still pretty close to where they were at the end of last year and or coming off even some of the highs that we've seen. There's been significant rotation underneath. A lot of those technology companies have really reset this year. You've had financial services companies reset in lots of different sectors, and as different AI iterations have rolled up, you've had a whole rolling set of under the surface resets, if you will, even while you've basically got the indexes pretty flat, even while earnings have accelerated by double digits. So you're growing into the earnings and the valuations that you've got. And the best part for markets is we have another earnings season starting next week, kicking off bigger the following weeks, and the markets will have lots of fundamentals to dig into.
They will, and of course, company management will be under pressure to articulate what they see and quantify the impact of rising oil prices, the degree of uncertainty that they face. Do you expect to see projections withdrawn, forecasts withdrawn, or at least suspended for a quarter or two?
I don't think we'll see them pulled back the way they were last year. And we've actually published a couple times some really interesting charts. We go through and look at the earnings season that was post-Liberation Day last year, and all the expectations got pulled way down, and then teed us up for really nice beats, if you will, through the remainder of the year. I don't expect we'll see that. The great part is management will all be held to account because this has been going on for half of the quarter. So people will be able to say, what are you doing? How are you seeing it? How is it coming through? There's some sort of, for some companies, there's the offset of IEEPA tariff revenue at least not going out anymore, if not coming back. So you've got potential offset. So it's a really newsworthy season, if you will.
All right, well, we look forward to that and speaking with you again as well. Carol Schleif is Chief Market Strategist at BMO Wealth Management. Coming up on Bloomberg Markets, most markets are closed tomorrow, but the U.S. will be publishing a highly anticipated jobs report, and the market for bonds, government bonds, will be open for half a day as a result. This is up next, right here on Bloomberg.